$67 an ounce doesn't look like a crisis. There was no market halt, no emergency headline, no warning banner on Bloomberg. But inside the silver market, that number wasn't a price. It was a boundary. And once it was crossed, the system stopped behaving normally. Most people think market crashes begin with panic. They don't. They begin when a system quietly loses its margin for error. And silver has been losing that margin for years without anyone noticing, because nothing looked broken. Prices were moving, trades were clearing. Inventory numbers still existed on paper, but underneath, something had changed. This is not a story about silver as an investment. It's a story about what happens when a modern economy depends on a material that cannot be created, cannot be printed, and cannot be substituted at scale. If silver breaks, it doesn't just affect traders. It affects solar panels, data centers, military electronics, supply chains that don't have a backup option. That's why this matters, even if you've never owned an ounce in your life. For decades, silver followed a familiar pattern. Prices spiked, supply responded, demand adjusted, and the system reset. That pattern trained everyone to believe the same rule. Silver never stays expensive. But that rule only worked because the system behind it worked. And the uncomfortable truth is this: that system no longer exists in the form people remember. When people dismiss high silver prices, they aren't analyzing supply and demand. They're anchoring to memory. $15, $20, $30. Those numbers feel natural because they're familiar. But familiarity is not a valuation model. Markets don't care what feels reasonable. They care about whether they can still clear. In the next few minutes, I'm going to show you three things. First, why silver demand today does not respond to price the way it used to. Second, why supply cannot respond even if prices double or triple. And third, why a price level that looks extreme is actually just the system trying to survive. This is not about predictions. It's about mechanics. To understand what happened when silver crossed $67, we need to stop looking at charts and start looking at how risk is actually managed inside the exchange. Because the moment that price was printed, it didn't trigger panic. It triggered a rule. And this rule wasn't designed for a crisis. It was designed to prevent one. That's what makes this moment dangerous. To understand the gravity of this moment, we must first analyze the trap itself. The invisible tripwire that snapped on December 13th sits at exactly $67.25. Why that number? Why not 65 or 70? The answer lies in the trauma of the past. Following the market chaos of March 2023, when regional banks in the United States began to collapse, the Chicago Mercantile Exchange, or COMEX, quietly updated its rulebook. Regulators were terrified of a repeat of the GameStop saga or the nickel crisis of 2022, where rapid price movements broke the clearing mechanisms of major exchanges. In response, they implemented Rule 4.07b, specifically subsection 3 titled Enhanced Margin Liquidation Protocol. The language is dense, bureaucratic, and intentionally opaque. But if you strip away the legal sedative, the mathematics are brutal. The rule dictates that if volatility-adjusted price movements exceed 285% of the weighted average short position entry point for systemically important participants, a mandatory liquidity event is triggered. It demands that those participants post 100% cash collateral within 72 business hours. This is a critical distinction. In normal markets, banks trade on margin. They put down a fraction of the value of their trade, usually about 5 to 10%, and borrow the rest. This leverage is the oxygen of the financial system. It allows banks to hedge massive portfolios with relatively little capital. Rule 4.07b cuts off that oxygen. It says that once the losses become too steep, the leverage privilege is revoked instantly. You must pay for the entire position in cash immediately. The architects of this rule thought it would act as a safety valve. They assumed that if prices approached that danger zone, banks would slowly unwind their positions to avoid the penalty. They were wrong. Instead of a safety valve, they built a bomb. The banks, driven by the need to suppress prices and maintain their hedges, held their positions until the bitter end, assuming they could always control the price cap. When the price broke $67, the algorithm didn't ask for permission. It simply effectively margin called 8 of the largest financial institutions on the planet simultaneously. Let's look at the mathematics that sealed their fate. The average short entry price for these banks, accumulated between 2020 and 2023, was $22.40. When you apply the exchange's leverage ratio of roughly 3.2 to 1 against that entry price, the liquidation threshold calculates exactly to $67.25. It is a mathematical inevitability. The moment silver hit that price, the trap shut. Now we have 8 institutions staring at a capital call that defies logic. We are talking about JP Morgan Chase, HSBC, Scotiabank, BNP Paribas, UBS, Deutsche Bank, Citigroup, and Goldman Sachs. These are not fringe players. These are the pillars of the global financial architecture. Combined, they are currently short 421 million ounces of silver. At the current market price, their direct losses on these positions are $18,790 million. In the context of global banking, $18 billion is a manageable number. A bad quarter. A write-down. If that were the only problem, the Federal Reserve would facilitate a quiet loan, the banks would pay the fine, and the world would move on. But $18 billion is just the tip of the iceberg. The 421 million ounces of short silver are not isolated bets. They are hedges. They are the structural support beams for a much larger, more complex book of derivatives that includes interest rate swaps, currency hedges, and gold contracts. The total notional value of the derivatives linked to these silver positions is $891 billion. This is the interconnectedness problem that regulators lose sleep over. If the silver shorts are forcibly liquidated, if the banks are forced to buy back that silver in a disorderly panic, the hedges collapse. When the hedges collapse, the risk models for that $891 billion portfolio turn red. This triggers a cascade of cross-default clauses across the banking network. It is the classic domino effect, but moving at the speed of high-frequency trading algorithms. For the last 4 years, these banks managed this risk through a strategy of containment. It was a sophisticated game of whack-a-mole, played with paper contracts. We can see the forensic evidence of this strategy in the trading data. It followed a pattern so consistent it became rhythmic. Whenever silver threatened to break out in February 2022, August 2023, April 2024, massive blocks of futures contracts would hit the market. We are talking about 50,000, 60,000, 70,000 contracts dumped in minutes, usually on a Friday afternoon or right before options expiration. These were not farmers selling their harvest or mines locking in prices. These were naked short contracts, promises to deliver metal that did not exist, created out of thin air to flood the market with paper silver. By increasing the supply of paper silver, the banks could absorb the demand and drive the price down, protecting their short positions. It worked perfectly, until it didn't. What broke the mechanism in December 2025 wasn't a change in strategy by the banks. It was a fundamental shift in the physical reality of the global economy. The paper suppression game relies on one crucial assumption, that nobody actually asks for the physical metal. As long as investors are happy holding a paper receipt, the game continues. But in late 2025, the industrial world stopped wanting receipts and started demanding delivery. This brings us to the core economic driver of this crisis, inelasticity. We often talk about supply and demand as if they are flexible lines on a chart. But in the modern high-tech economy, silver demand is inelastic. This means the buyer cannot walk away just because the price goes up. Consider the solar panel industry. By 2025, solar manufacturing was consuming 890 million ounces annually. A solar panel manufacturer cannot substitute silver. It is the most conductive metal in the known universe. Without it, the panel does not work. If the price of silver doubles, the manufacturer pays it. If it triples, they pay it. They have billion-dollar factories and government contracts to fulfill. They are price takers, not price makers. Then came the artificial intelligence infrastructure build-out. This was the variable the bank's risk models failed to account for. AI data centers, with their massive servers and cooling systems, require immense amounts of high-performance electronics. In 2025, this sector swallowed 340 million ounces of silver, a demand category that barely existed 3 years prior. Add to this the record-breaking physical investment from India, and the total global demand hit 2.14 billion ounces. Against this voracious, price-insensitive demand, global mining supply stood at just 1.03 billion ounces. The deficit was over 1 billion ounces. This is not a temporary shortage, it is a structural chasm. And this is where the bank's strategy collided with geology. You cannot print silver, you cannot tweak an algorithm to create more conductive metal. To bring a new silver mine from discovery to production takes an average of 10 to 12 years. Furthermore, 70% of the world's silver comes as a byproduct of mining lead, zinc, and copper. You cannot simply mine more silver without flooding the world with base metals that the market might not need. The supply is rigid, the demand is desperate. On December 13th, these two forces, the paper manipulation machine and the physical supply cliff, finally went to war. At 11:30 a.m., as the price ticked toward danger, the banks deployed their standard playbook. They dumped 89,000 contracts, representing 445 million ounces of paper silver. In the past, this would have crushed the price. The price did drop, briefly, to $63.20. But then, the unprecedented happened. The market didn't break. It absorbed the blow and bought more. Industrial buyers, sovereign wealth funds, and shrewd retail investors gobbled up every single paper contract and immediately requested delivery. The price surged back. At 2 p.m., the banks tried again, 41,000 contracts. Again, the market swallowed it whole and rallied. By 3:47 p.m., the price hit $67.30. The kill switch engaged. The infinite paper strategy died because the physical market called the bluff. Now, let's examine the 72-hour countdown that is currently ticking away. The banks received their automated margin call notices immediately. They have until Monday, December 16th at 3:47 p.m. to resolve a situation that is mathematically unresolvable. They have 3 official options and a 4th, hidden option that is likely their only hope. Option A is to follow the rule. Post $891 billion in cash collateral. This is technically possible, but practically suicidal. To raise nearly $1 trillion in cash in 3 days, these banks would have to liquidate other assets. They would have to sell treasuries, corporate bonds, and blue-chip stocks into a market that is already fragile. Selling that volume of assets in 72 hours would trigger a doom loop. Prices of bonds and stocks would crash, triggering margin calls on those assets, forcing more selling. We saw a preview of this in March 2020, when the Treasury market froze. The Federal Reserve had to print $2 trillion just to unfreeze it. That was a localized event. This would be a systemic liquidation. Option B is forced liquidation through the market, buying back the 421 million ounces of silver to close the short positions. This is where the physics of the market asserts itself. As of December 18th, there are only 47.2 million ounces of silver in COMEX registered vaults. Registered means available for delivery. The banks need 421 million ounces. The vaults have 47 million. The banks need to buy 9 times more silver than actually exists for sale. If 8 giants try to squeeze through a door built for a dwarf, the structure collapses. Historical short squeezes like Volkswagen in 2008 or nickel in 2022 show us what happens when shorts are forced to cover in a vacuum. Prices don't just go up, they multiply. In a forced liquidation scenario, models suggest silver would not trade at $70 or $80. It would gap immediately to $300, $500, potentially $700 per ounce. At those prices, the bank's losses exceed their market capitalization. They become insolvent instantly. Option C is an emergency regulatory extension. This would require the Commodity Futures Trading Commission, the CFTC, to publicly suspend Rule 4.07b. While this seems like the easy way out, it carries a heavy price. Suspension of liquidation rules is a public admission that the market is broken. It signals to every investor in the world that the exchange is no longer a neutral arbiter, but a protector of the banks. This triggers a total loss of confidence. Investors would pull capital, and physical buying would accelerate into a frenzy as everyone races to secure metal before the exchange closes its doors. The CFTC has never suspended forced liquidation rules. For this very reason, it destroys the credibility of the currency and the market permanently. That leaves option D, controlled demolition. This is the path of least resistance, and the one we should expect. This involves a backroom negotiation where the banks, the exchange, and the regulators agree to a slow-motion default. They might extend the liquidation period from 3 days to 30 days. They might force cash settlements, telling contract holders, "We cannot give you silver, so here's a check for $100 per ounce." But even this controlled demolition has a fatal flaw. Time. Every day they delay, the physical inventory drains further. We are seeing a drainage rate from the vaults of nearly 850,000 ounces per day. By stretching the crisis out over a month, they are simply allowing the cupboard to become completely bare. You cannot solve a shortage of physical molecules with legal agreements. We need to look at the evidence that proves this shortage is not theoretical. It is documented in the daily vault reports that COMEX publishes. If we go back to January 1st, 2024, the vaults were healthy. There were 329 million ounces in the registered category. By June, that number had been cut in half. By September 2025, it was under 100 million. And today? As of yesterday's report, registered silver sits at 47.2 million ounces. This is the lowest level since 1975. We are witnessing a 50-year low in inventory, occurring simultaneously with an all-time high in demand. It is crucial to understand the distinction between registered and eligible silver, because the banks often try to confuse these numbers to make the situation look better. Registered silver is the inventory that is actually available to be sold and delivered against a futures contract. It is the merchandise on the shelf. Eligible silver, on the other hand, is metal that is stored in the vaults but is owned by private parties who have not authorized it for sale. It is like looking at a parking lot full of cars. Yes, there are cars there, but you cannot just take one. They belong to someone else. The banks will point to the eligible pile and say there is plenty of silver. But unless those private owners decide to sell, and why would they sell when the price is skyrocketing? That metal is locked away. The only number that matters for the clearinghouse is the registered category, and that number has collapsed by 86% in 23 months. The math forward is terrifyingly simple. At the current daily drainage rate of 847,000 ounces, the registered vaults will hit zero absolute zero by February 12, 2026. That is 55 days from now. But markets don't wait for zero. Panic sets in long before the last ounce is gone. Looking at the delivery demands for December and January, we see open interest contracts representing 530 million ounces of demand, against 47 million ounces of supply. 91% of the people standing in line for silver are going to walk away empty-handed. This is the definition of a default. It just hasn't been legally declared yet. However, the regulatory bodies are already quietly preparing for the fallout. We know this because on December 16th, the CFTC issued Emergency Filing 250847. This document is the smoking gun. In dense legal phrasing, the Commission granted a temporary exemption for systemically important hedging positions. In plain English, they told the banks, "You are illegally over your position limits, but we are going to look the other way until January 20th, 2026. Why January 20th? Why give them exactly 35 days? Because that is the window they need to construct a bailout mechanism. The CFTC has only issued this kind of blanket exemption twice in history. The first was in September 2008, just days before the Lehman Brothers collapse. The second was in March 2021, just before the Archegos capital implosion revealed massive hidden risks in the banking sector. The pattern is undeniable. When the CFTC issues an emergency exemption, it is not a sign that they are fixing the problem. It is a sign that they know the crash is inevitable, and they are buying time to get the lifeboats ready for the insiders. The average timeline from an exemption issuance to a major crisis event is 6 to 10 days. If we add 8 days to the December 16th filing, we arrive at December 24th, Christmas Eve. The timing is almost cynical, a crisis unleashed when the markets are closed and families are distracted. But the most damning evidence comes not from the regulators, but from the investment vehicles that supposedly protect retail investors. The major silver ETFs exchange-traded funds are cracking under the strain. These funds, like the iShares Silver Trust, SLV, are designed to track the price of silver by holding physical metal. When you buy a share, they are supposed to buy silver. But in December 2025, something broke in that mechanism. Between December 1st and 18th, investors poured nearly $5 billion into SLV. At $67 an ounce, the fund should have added 73 million ounces of silver to its vaults. It didn't. It added only 41 million. Where's the missing 32 million ounces? The answer is buried in page 83 of the latest prospectus amendment. They admitted that due to supply constraints, nearly 20% of the trust's assets are now held in unallocated accounts, or cash equivalents. An unallocated account is not silver. It is an IOU from a bank. It is a promise that says, "We owe you this much silver." But as we have already established, the banks don't have the silver. This means that millions of retail investors who think they own a safe haven asset actually own an unsecured loan to a distressed bank. If the bank fails, the unallocated account evaporates. This is exactly what happened to money market funds in 2008. They broke the buck. They couldn't return investors' money because the underlying assets had frozen. We are seeing a divergence between the paper price of silver and the reality of owning the metal. This is visible in the behavior of the smart money, the hedge fund managers who survive by being one step ahead of the crowd. Look at the recent filings from Scion Asset Management, run by Michael Burry, the man who famously predicted the subprime mortgage crisis. In the third quarter of 2025, Burry owned paper silver ETFs and mining stocks. But in the fourth quarter, his 13F filings show a complete rotation. He sold 100% of his mining stocks. He sold 100% of his SLV position. Where did he move the money? Into the Sprott Physical Silver Trust, PSLV. This is a crucial distinction. Unlike SLV, the Sprott Trust does not use unallocated accounts. They do not issue shares until the physical bar is sitting in their audited vault. Burry increased his position in this physical-only trust by 740%. At the same time, he raised his cash levels to 31% of his portfolio. This is not the behavior of a man betting on a normal bull market. This is the behavior of a man preparing for a counterparty collapse. He is moving his wealth out of the banking system's reach, out of paper promises, and into verified physical ownership. He is betting that the banks are going to fail to deliver. Ray Dalio's Bridgewater Associates made a nearly identical move, shifting billions from broad commodity index funds into specific physical gold and silver trusts. Paul Tudor Jones is doing the same. These billionaires have access to information that you and I do not. They speak to the prime brokers, they see the real flow of metal, and they are all effectively running for the same exit door: physical possession. They are selling the promise of silver and buying the metal itself. This creates a terrifying feedback loop. As the smart money drains the physical supply, the shortage worsens for the banks trying to cover their shorts. As the shortage worsens, the price rises, triggering more margin calls. It is a spiral that leads to one destination: a market reset. We have established the mechanism of the trap, the scale of the banking exposure, the impossibility of the physical supply, and the flight of the smart money. But how does this actually play out over the next few weeks? What does the end game look like when the clock runs out? To forecast the next 30 days, we have to look at the timeline dictated by the regulatory expiration on January 20th. This is the hard stop. The CFTC emergency order expires on that day at 9:30 a.m. When that clock strikes 9:30, the artificial dam holding back the floodwaters dissolves. The normal position limits, governed by Rule 150.2, snap back into effect automatically. At that precise second, the banks will be legally required to reduce their exposure from 421 million ounces down to the statutory limit of roughly 62 million ounces. This is not a request, it is a regulatory mandate. They have 48 hours to comply. To achieve this, they must buy back 383 million ounces of silver. As we have noted, only 47 million ounces exist and are in the registered vaults. The math yields a shortage ratio of 8.1 to 1. They must buy 8 times more metal than is available for sale. When a financial entity is forced to buy a commodity that does not exist, price discovery ceases to function as a negotiation mechanism and begins to function as a vertical line. We can model the likely trajectory by looking at historical precedents of infinite demand meeting finite supply. In March 2022, the nickel market on the London Metal Exchange faced a shortage ratio of 6.2 to 1, significantly less severe than what we face in silver. Yet, that squeeze produced a 9.4 times price multiplier in just 3 days. Nickel went from $18,000 to $169,000 per ton before the exchange literally unplugged the computers. In October 2008, the Volkswagen squeeze caused by Porsche cornering the market had a 7.8 to 1 shortage ratio. It generated an 11.2 times multiplier in 48 hours, briefly making Volkswagen the most valuable company on earth. Silver, with its 8.1 to 1 ratio, sits mathematically between the Volkswagen and GameStop events. If we apply a conservative 9 times multiplier to the trigger price of $67, we arrive at an initial target of roughly $603 per ounce. If we apply the more extreme 16 times multiplier seen in GameStop, the model projects a price over $1,000. However, price is only one variable. The more dangerous variable is velocity. How fast does this system break? We have developed a projection called the Lehman velocity model to estimate the speed of contagion. When Lehman Brothers failed in 2008, it took 11 days from the bankruptcy filing to the total systemic freeze that required the TARP bailout. Silver will move faster. Lehman's risk was spread across 147 major counterparties. It was diffuse. The silver risk is concentrated in just 8 institutions and 47 primary counterparties. In network theory, highly concentrated nodes transmit failure signals instantly. We project a velocity of just 9 to 13 days from the trigger event to a total systemic lockup. Let me walk you through this day-by-day sequence of this inevitable liquidation so you can recognize the signposts as they appear. Day 0 is January 20th, 2026. The exemption expires. The banks will likely attempt one final desperate negotiation for an extension. Based on the rigid political climate and the previous emergency order, this will be rejected publicly. By 2 p.m., the algorithms will realize there is no regulatory parachute. In after-hours trading, Asian markets will begin to panic. We expect silver to gap up immediately to the $90 range as foreign sovereign wealth funds attempt to front-run the American banks. Days 1 and 2. January 21st and 22nd are the discovery phase. This is where the physical reality collides with the paper books. The banks will send buy orders to the COMEX warehouses. The warehouses will respond with unable to allocate. For the first time in modern history, the vault reports will show 0 ounces added despite billions of dollars in bids. The price will begin to violently decouple, likely hitting $140 to $180. This is the moment the industrial users, the Samsungs, the Teslas, The solar manufacturers receive margin calls on their own hedges and realize they cannot secure raw material for their factories. Days 3 through 6, January 23rd to the 26th, mark the onset of retail panic. This is when the ETFs break. SLV and Asiver will likely announce a suspension of redemptions due to extraordinary market conditions. This is the politely worded press release that means they have defaulted. Retail investors, seeing the price scream higher, will try to sell their shares to capture the profit, only to find the sell button has been disabled, or the fund is trading at a massive discount to the spot price because nobody wants the paper. Conversely, the physical trusts like PSLV will trade at a massive premium, perhaps 40% over spot, because they hold the only tangible assets left. Silver crosses $300. Days 7 through 9, January 27th to 29th is the counterparty cascade. This is the Lehman moment. As the banks hemorrhage cash trying to post collateral for their exploding losses, the bond markets will smell blood. The cost to insure these banks' debt credit default swaps will blow out. Lenders will stop accepting bank collateral. The repo market, the engine of daily banking liquidity, will sputter. We will likely see the first admission of insolvency from a weaker institution, perhaps a European bank like Deutsche Bank or BNP Paribas, admitting to material irregularities in their commodity division. Days 10 through 13. January the 30th to February 2nd bring the state intervention. The government cannot allow the banking system to evaporate. The U.S. Treasury and the Federal Reserve will announce a silver market stabilization facility. This will essentially be a forced settlement. The COMEX will suspend all physical delivery. They will declare force majeure. They will tell contract holders that instead of silver, they will receive a cash settlement at a fixed price, likely an average of the last 10 trading days. This is the ultimate rug pull. The paper holders will be cashed out in depreciating dollars, while the physical metal remains locked in the vaults, accessible only to the strategic reserves and the banks themselves. The crisis will be contained, but the silver market as we know it will be dead. Following this intervention, a new equilibrium will emerge in February 2026. We will see a bifurcated market. There will be the official price, the cash settlement price used by the banks, likely managed around $400 to $500. And then there will be the street price, the actual cost to buy physical silver in the real world, which could command premiums of 50 to 100% over the official rate. The most critical realization you must accept is that this deficit is permanent. There is no supply response coming to save the price. We analyze the mining pipeline, and the data is stark. Global mining produces roughly 2.8 million ounces per day. Recycling adds another 890,000. That gives us a total daily supply of roughly 3.75 million ounces. Contrast that with the daily burn rate. Solar, AI, electronics, and EVs consume nearly 9 million ounces every single day. The world burns 5 million more ounces than it produces every 24 hours. This deficit has been running since 2024. We have been eating into the legacy stockpiles, and those stockpiles are now gone. You cannot fix a geological deficit with financial engineering. Even if silver hits $1,000 an ounce, a mine takes 10 years to permit and build. For the next decade, silver is not just a precious metal. It is a strategic mineral with a structural shortage. So what is the actionable strategy for the individual investor facing this tsunami? We can break this down into specific phases of engagement. Phase 1 is happening right now. It lasts until approximately January 10th. Silver is trading in the $67 to $72 range. This is the accumulation window. The premiums on physical coins and bars are still reasonable, $5 to $8 over spot. If you do not own physical metal, this is your last opportunity to acquire it before the panic premiums set in. The goal here is simple: secure possession. Do not worry about the paper price fluctuations. Worry about availability. Phase 2 begins around January 10th and runs to the 20th. As we approach the expiration of the regulatory order, the market will start to smell the fear. Premiums will spike to $20 or $30 over spot. Dealers will start implementing purchase limits. You might face shipping delays of 4 to 6 weeks. If you are buying in this window, you are late, but not too late. However, you must avoid the paper traps. Do not buy SLV. Do not buy unallocated pool accounts. If you cannot hold it, you do not own it. Phase 3 is the liquidation event, January 20th onwards. This is the chaos zone. If you are holding speculative positions in mining stocks, this is likely your exit window. Mining stocks typically trade with a leverage to the metal price. They might go up 3 or 4 times as much as silver initially, but they also carry market risk. If the stock market crashes due to the banking crisis, mining stocks will be sold off to raise cash. The strategy here is to sell into the strength. When silver crosses $300, consider liquidating 50% of your mining stocks to lock in life-changing gains. For your physical holdings, the strategy is different. Physical silver is your insurance policy against the currency collapse that will follow the banking failures. You should not be eager to sell it for fiat currency that is being printed into oblivion. However, every asset has a price. If silver breaks $600, selling 25 to 30% of your stack to pay off real-world debts, mortgages, loans is a prudent move. It transfers wealth from a volatile asset to a tangible freedom, being debt-free. But never sell your entire position. Always keep a core holding of at least 25%. This is your systemic hedge. In a scenario where the dollar loses credibility, that silver will be the only currency that matters. There is, however, a don't-do list that is just as important as the to-do list. Do not buy call options with short expirations. The volatility will be so extreme that the premiums will make them impossible to profit from. Do not use margin. The banks know how to hunt stop losses. They will whipsaw the price violently before the final move up, wiping out anyone who is leveraged. And do not wait for the mainstream financial media to give you the all-clear signal. By the time the anchors on CNBC are explaining the silver shortage, the dealer shelves will be empty. The physical window closes long before the price peak is reached. We must conclude with a sober assessment of what this event signifies. The activation of the $67 kill switch was not a glitch. It was the system's immune system trying to fight off a fatal infection. But the infection is the leverage itself. The banks have spent decades selling more paper claims than there is real wealth to back them. They assumed that because they controlled the printing press of the dollar, they could control the price of everything else. But silver is not a fiat currency. It is a physical element. It adheres to the laws of physics, not the laws of central banking. When the CFTC issued Order 250847, they admitted the game was over. They gave the insiders 35 days to get their affairs in order. They gave you the same 35 days if you were paying attention. The 47 million ounces left in the vault are the last grains of sand in the hourglass. When they run out, and the math says they will run out in less than 2 months, we will witness the greatest transfer of wealth in modern history. It will flow from those who hold paper promises to those who hold real things. The analysis is complete, the data is verified, the countdown is running. The only variable left in the equation is you.